Hi everyone, welcome to today's video. Today we're going to look at one of the important instruments available for retail investors like you and me to save for financial goals or to build a long-term wealth. Yes, I'm talking about mutual funds. Today's video we will look at objective of mutual fund, why they exist, how the mutual fund companies are structured, and what are the different mutual fund schemes available for retail investors to choose from. Let's get started. For a very long time, ordinary investors in India have relied heavily on traditional saving instruments like FD, LIC policy, or gold. But after adjusting for inflation, the rate of return from these instruments have not been very attractive. The other option they had is to invest in equity, but not everyone had time and expertise to do a research and pick stocks. That's when mutual fund companies came to rescue. The mutual fund companies help retail investors to invest their money into risky assets like equity for a marginal fee and help them to build a long-term wealth at much better rate. That's why the mutual funds have been popular for the last 2 decades, and it has become inevitable part of anyone's portfolio. Mutual funds are not managed by just one company. There are a group of companies come together to manage the investors' money in best possible manner and in a controlled and regulated manner. The companies are sponsors, mutual fund trust, AMC or asset management companies, custodians, and registrars. Don't be baffled. We will look at them in detail one by one. Let's start with sponsors. Sponsors are companies that invest their capital to start a mutual fund company. For example, in the case of ICICI Prudential Mutual Fund Company, ICICI Bank is one of the sponsors and one of the other sponsor is Prudential PLC. Mutual fund trust consists of board of trustees who define the guidelines for asset management companies to manage investors' money in prudent manner, and they also enforce asset management companies to comply with external regulations of SEBI. AMC or asset management companies are the most visible one when we talk about mutual fund. They are the one who define and operationalize mutual fund schemes. It consists of sophisticated investment expert who define the investment strategy and they take decisions on when to buy a particular company and when to exit. Examples for AMCs are HDFC AMC, which is listed in stock market, ICICI Prudential AMC, Canara Robeco AMC, and many more. Custodians are banks or any financial institutions that hold the securities of a mutual fund. For example, AMCs make a decision to buy a X number of shares of a company, and those share certificates should be stored somewhere, and custodians take care of that. Some of the examples of custodians are ICICI Bank, HDFC Bank, Stock Holdings of India, Axis Bank, and so forth. You can check details about the custodians of a particular mutual fund company in their website. Registrar and transfer agents are third party companies that help mutual funds in record keeping. They track the transactions made by an investor towards a mutual fund company. They track transactions like initiation of a SIP or redemption of units or any changes to nominee or personal information within the mutual fund investment folio. Some of the registrar and transfer agents operating in India are CAMS, Carvey, Sundaram BNB Paribas, and Franklin Templeton. Mutual funds are broadly classified based on the assets they invest in, the geography they invest in, the sector they invest in, the theme they invest in, and the solution they invest in. Based on the asset class the mutual fund invests in, the mutual funds could be classified into equity based mutual fund, debt based mutual fund, gold based mutual fund, and so forth. Further, within equity mutual fund, based on the market cap of the company they invest in, the mutual fund could be further classified into large cap, mid cap, and small cap mutual funds. The debt mutual funds could be subclassified into ultra short term funds, long term funds, medium term funds, corporate bond funds, gilt funds, and so forth. Mutual funds are created to focus on certain sector, and those mutual funds are known by the sector name. For example, if a mutual fund focuses on pharma companies, then the mutual fund is known as pharma fund. Mutual funds also invest in certain trends. For example, ever since electric vehicle became a trend, we have mutual funds that invest in companies that focus on manufacturing of electric vehicle, installation of infrastructure required for electric vehicle, and so forth. We also have mutual funds created specially for a certain financial goal, for example, children's education or retirement. Those plans are called solution based mutual funds. Finally, we have something called index funds or passively managed funds. They're called passively managed funds because they are not actively managed by a fund manager. Instead, index funds mimic a certain index. For example, if an index fund is created based on Nifty, then the fund invests in all the companies that make up Nifty index. Similarly, if a fund is created based on S&P index, then the particular fund invests in all the companies that make up S&P index. With this, we come to end of today's video. Next session, we will look at how one can select a mutual fund that suits their financial goals. Hope you liked today's content. If so, please like, share, and subscribe to our channel. Also, share today's content with your friends. Thank you.